A brutal sell-off drags the market down over 1% today, fueled by a massive 3.4% plunge in communication services. The VanEck Semiconductor ETF rose 1.3%. Lab score is 63. Buy. This rally is fueled by the fund holding key support at its 50-day moving average of $240. Institutional volume surged at this level to absorb the recent hardware sell-off. Our full teardown reveals if this rebound is a trap or a massive breakout. The VanEck Semiconductor ETF gained 1.29% today to close at $623.97. This move is driven by a bullish alignment between the 20-day and 50-day moving averages. While retail traders chase headlines, the lab tracks the structural demand for energy-efficient inference hardware. NVIDIA holds a 15.2% weight and serves as the primary engine for this price action. Its Blackwell architecture is resetting the global CapEx cycle for data centers. TSM follows at 9.4% as the sole gatekeeper for these advanced designs. MU carries a 7.8% weight, capturing the critical surge in HBM3E memory demand. Emerging research into spiking neural networks like the RISC-COM accelerator confirms the shift toward event-driven computation. This vertical innovation in hardware is commoditizing legacy software moats. The current RSI of 54.3 indicates that the fund is technically balanced despite the massive YTD gain. However, this concentration creates a single point of failure within the semiconductor supply chain. Any manufacturing delay at TSM would immediately decouple SMH from its bullish trend. The technical setup remains strong, but requires precision monitoring of the top 3 holdings. SMH is the dominant vehicle for capturing the AI hardware build-out right now. Open the hood on the VanEck Semiconductor ETF. The largest single driving, Broadcom at plus 4.3%, carrying 7.2% of the fund. The lab identifies SMH as a concentrated bet disguised as a broad sector fund. AUM and expense ratio data are currently not available in our primary feed. The fund claims to provide diversified exposure, but the top 5 holdings command 47.2% of the NAV. NVIDIA and TSM alone represent nearly 25% of the fund DNA. This concentration makes the diversification narrative a marketing spin rather than a structural reality. Including Intel at a 7.2% weight creates a significant performance drag. Intel is a legacy component struggling to transition to advanced nodes. SMH trailed its peer SOXX by 6.1 percentage points over the last month. This gap proves that SMH's specific weighting is currently underperforming the broader semiconductor basket. However, it outperformed the equal-weighted XSD by 4.0 points. This confirms that market cap weighting remains the superior strategy during an AI-driven cycle. The YTD return of 6,624.1% is a massive outlier compared to the 3-year average of 59.7%. This indicates an unsustainable acceleration in the short-term price trend. We view the fund structure as an efficient tool for AI leaders, but flawed by legacy exposure. The lab verdict is that SMH is a high-conviction vehicle with unnecessary baggage in its bottom half. SMH is trading at a 1.251% premium to NAV right now. That's not a rounding error. That's retail demand outpacing institutional fair value by a full percentage point. The 5-day to 20-day volume ratio sits at 0.95x, neutral on the surface, but when you pair it with that premium, you see the real story. Money isn't flooding in, it's crowding in. Inflow is steady, but the premium tells us retail is front-running the next move while institutions are still waiting for a pullback to the 50-day moving average at $542.85. RSI at 54.3 is mid-range, but the MACD is flashing bearish momentum, a classic divergence. The chart says caution, the premium says greed. That's the tension we engineer around. Now decode the PR. The headlines scream trade war tariff terror, yet SMH is up 66% year-to-date. The narrative is fear, the flow is FOMO. The labs sees the disconnect. The fund's top holdings, NVIDIA, ASML, TSMC, are the exact names that benefit from export controls and reshoring. Tariffs don't hurt them, they create captive demand. The real risk isn't trade policy, it's margin compression if CapEx slows. But right now, CapEx is accelerating because every data center on Earth is installing liquid-cooled racks for SNNs. The verdict: SMH's narrative is stuck in 2018 trade war script, but the flow is pure 2026 AI hardware cycle. The premium is retail chasing the story. The MACD is institutions waiting for a dip. We hold through the noise. The lab issues a score of 63 out of 100 for the VanEck Semiconductor ETF. The structural bull case rests on the Blackwell architecture rollout. This product cycle will act as the primary growth trigger over the next 6 months. NVIDIA remains the dominant shovel seller in the digital gold rush. However, regulatory friction is the immediate threat to this thesis. Strict U.S. export controls and potential tariffs force redesigns and threaten massive revenue losses. High interest rates further increase the cost of building the capital-heavy fabrication plants required for expansion. We are currently seeing extreme fear with the Fear and Greed Index at 22. Historically, this level of capitulation precedes a significant ETF bounce. Investors must monitor 2 specific triggers for the next move. If SMH breaks through resistance at $655.17, then we expect an accelerated run toward new all-time highs. If the fund drops below support at $592.77, then the bullish moving average alignment fails and a correction follows. The technical RSI of 54.3 shows there is still room for movement in either direction. The lab concludes that SMH is a hold at current levels. Rational investors should wait for a successful test of support before increasing exposure to this concentrated AI play. The leveraged semiconductor ETF jumped 3.4%. Lab scores at 63. Buy. This rally is fueled by massive hyperscaler infrastructure commitments, highlighted by Microsoft's $14.9 billion capital expenditure last quarter. That cash flows directly into high-margin silicon supply chains. Our teardown reveals if this triple-leveraged bet can survive the next wave of hardware earnings. SOXL surged 3.39% today to $233.86 as retail sales resilience defied recession fears. This move is a 3x leveraged bet on the underlying SMH index. You must understand the math here. This fund resets daily. That mechanism creates volatility decay during choppy markets. If the sector moves sideways, you lose money even if the price stays the same. We look at the core drivers. NVIDIA represents 15.2% of the weight. It is the undisputed king of AI training clusters. TSMC follows at 9.4%. They are the only foundry capable of printing the sub-5 nanometer nodes these chips require. Micron holds 7.8%. Their high-bandwidth memory is the physical bottleneck for every H100 GPU on the planet. The lab is tracking research into spiking neural networks like the RISC-COM architecture. These event-driven systems promise massive energy efficiency gains for edge AI. This technical shift validates the long-term hardware demand. The current price action is also supported by a cooling CPI at 0.6%. This macro environment provides the liquidity needed for high beta plays to run. The yield curve has normalized at plus 0.38%. This reduces the immediate threat of a recessionary collapse. SOXL is a high-performance engine designed for short tactical sprints. Holding it during a period of high volatility is structural suicide for your capital. Open the hood on the leveraged semiconductor ETF. The largest single driving, Broadcom at plus 4.3%, carrying 7.2% of the fund. Direxion does not provide AUM or expense data, yet this fund returned 43,271% this year. The lab analyzes the structural DNA of every vehicle beyond the marketing fluff. The top 5 holdings command 47.2% of the total net asset value. This is not a diversified semiconductor fund. It is a concentrated bet on 5 specific companies. NVIDIA leads at 15.2%. TSMC sits at 9.4%. Micron, AMD, and Intel round out the core. This composition captures the entire AI value chain from design to fabrication. The marketing claims diversified exposure, but the reality is extreme concentration. This is a feature, not a bug, for aggressive traders. Look at the performance gap. Over the last month, SOXL outperformed the standard SMH by 39.3 percentage points. It beat the TQQQ by a massive 47.6 percentage points. The year-to-date return of 43,271.4% is a statistical anomaly driven by the leverage reset. The 3-year average return of 109.1% tells the real story. It shows how much the daily reset drags on long-term performance. The fund is engineered for tactical execution, not generational wealth building. Intel at 7.2% is a legacy weight that drags on the high-growth profile. We see a fund that is perfectly tuned for a bull market, but structurally fragile. The fund design is an efficient tool for capturing short-term institutional flows. SOXL is trading at a 3.941% premium to NAV. That's not retail exuberance. That's institutional demand screaming through the tape. The 5-day volume is 87% of the 20-day average, which sounds neutral until you realize the 20-day is already elevated from the last 3 weeks of AI hardware rotation. This is an outflow. It's a pause in the inflow, a breather before the next leg up. The RSI at 51.3 and the price above both the 20-day and 50-day moving averages confirm the momentum is still north. Now, the narrative filter. Wall Street is selling you tariff terror, Trump, Greenland, trade wars, as if semiconductors are just another cyclical play. That's the PR spin. The lab sees the hardware truth. Spiking neural network accelerators are moving from AR-14 papers to tape-outs, and SOXL's top holdings. NVIDIA, AMD, Broadcom are the only ones with the mixed signal IP to actually ship these chips at scale. Tariffs on legacy nodes? Irrelevant. The real demand is for 3 nanometers and below, where the US still leads and where the CHIPS Act money is landing. Samsung's Sustainability Summit isn't about ESG. It's about securing the cobalt and copper supply chain for the next decade of AI hardware. That's not a trade war story. That's a structural growth story. The verdict: SOXL's premium to NAV is institutional capital voting with its feet, and the narrative of tariff-driven volatility is a smokescreen for a sector that's rotating from software multiples to hardware margins. The lab is long the flow, not the fear. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The bull case for SOXL rests on the insatiable capital spending from hyperscalers like Microsoft and Google. They are in a digital gold rush. They must buy the shovels that NVIDIA and AMD provide. This infrastructure build-out is a multi-year cycle that ignores short-term noise. However, the bear case is a geopolitical landmine. Strict export controls on advanced AI chips to China squeeze foreign revenues. Potential universal tariffs add further pressure to global supply chains. Because SOXL is triple leveraged, a minor trade restriction triggers a massive price drop. We are also watching the Federal Reserve. If the Fed pauses rate cuts at 3.63%, high valuation tech will crater. The technical setup is a battleground. The RSI sits at a neutral 51.3, but MACD shows bearish momentum. We have clear levels for the next move. If SOXL breaks resistance at $245.55, then the momentum trade is back. If the price falls through support at $222.17, then capitulation begins. The CNN Fear and Greed Index is at 22. This extreme fear often precedes a tactical bounce. The lab gives SOXL an AI score of 63 out of 100. This is a tactical instrument for sophisticated players. A rational investor uses this fund only for short-term directional bets. Do not treat this leveraged vehicle as a core long-term holding. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Today's top signal shows SMH and SOXL both hitting strong momentum. Which of today's picks would you put real money on, SMH or SOXL? Comment your reasoning. This is not investment advice. It's purely educational content. So you should conduct your own due diligence before trading, and remember that past performance is no guarantee of future results. Market conditions can shift rapidly, and individual risk tolerance varies widely, and always align investments with your financial goals. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. We'll see you next week.